In this question, you are being asked to decide which of the following statements about Xena Co. is correct. In order to identify the correct statement, you will need to review the individual ratios that have been given to you with the company information. The current ratio looks at the company's ability to repay its current liabilities with its current assets. And we can see that from the 20x9 results compared to the 20x8 results that they have less current assets to cover their current liabilities. We then have our receivable days ratio. This represents the average number of days that it takes the credit customers to repay the amounts that they owe the company. And so 20x9's result shows that there's an average of 75 days waiting for that money compared to 50 days from the year before. This is a substantial increase, and it's taking them longer to receive the payments from credit customers. The payable days ratio represents the number of days on average it takes them to pay their own suppliers. We can see that this has gone down from the previous year. Currently, we're showing 30 days on average to repay the amounts compared to 45 days from the year before. This teamed up with the receivable days ratios suggests that there could be cash flow problems where they're waiting for so long for their credit customers to pay them, and yet they're paying their suppliers so frequently. And finally, the ratio inventory turnover represents the average number of days that they are holding their inventory before it's being sold. We can see that this year's results is showing 42 days compared to last year, which was 35 days. So they're holding on to their inventory for longer. Looking at the statements that we have to decide upon, the first one says that Xena is taking longer to pay suppliers in 20x9. We can see that this isn't true because 30 days on average in the current year compared to 45 days suggests that they have shortened the time to repay suppliers. The second statement says that Xena is suffering from a worsening liquidity position in 20x9. This looks to be correct because we can see that in 20x9 we have the result 1.2 to 1 compared to 1.5 to 1 in 20x8. Just checking the other statements, Xena is receiving cash from customers more quickly in 20x9 than in 20x8. Again, this isn't true because we can see that it's taking them longer to receive their money from customers because it was 75 days on average in 20x9 and then 50 days in 20x8. And then finally, the last statement, Xena's liquidity and working capital has improved in 20x9. Based on the results of these ratios, we can see that liquidity and working capital has not improved. In fact, the opposite has happened. And so our second option, that Xena is suffering from a worsening liquidity position in 20x9, is the correct statement based on our current ratio results.